Hi, everyone. I just wanted to share some quick observations from Q1 2026. It's been said that markets climb a wall of worry, and Q1 2026 was no different. We started the quarter with concerns about AI spending and bubble risk. The narrative was that companies, particularly in the S&P 500, were spending way too much on the AI build out, too much on chips, too much on data centers, and that would ultimately result in a 2000 style .com crash. The narrative quickly shifted with an update from Claude's AI mid-quarter, and the concern changed to AI is too good. It's so good that it is going to eliminate many software companies, the so-called SaaS apocalypse. It's so good, it's going to eliminate jobs. And I think we know the truth will be somewhere in between there, but nobody knows how this is going to play out fully. Worries shifted then to private credit, which are funds that raise capital and loan that capital to private businesses to fund their growth. And there has been a significant amount of growth in that category. Did it grow too far, too fast? Was there lax underwriting, particularly to software companies? Again, too soon to see what the long-term ramifications are for that. And then, of course, the fourth major headline was the U.S. military action against Iran. And the major implication of that is the closure of the Strait of Hormuz. And that really is crippling the distribution of oil from the Middle East to the rest of the world. And what I wanted to point out is that climbing a wall of worry is not new. It's not just last quarter or what happened in the first or second quarter of 26, but we just mapped out the S&P 500 from 1925 through the end of last quarter, actually. And you could see the upward trajectory is, of course, up and to the right. And then we just plotted in some major worries, crises, concerns that were going on that the market still found a way through. And I suspect that when we have some room over here in the top right, we will add the AI worries and the US Iran conflict to this list. Want to close on what really happened in the quarter and how that affects investors. Given all of those negative headlines, you would have expected, I know I would have expected equity markets to have probably dropped further than they did. So these are the major asset classes that we use in our asset class returns quilt. Certainly the best performing asset for the quarter is commodities, and that's certainly due to oil going from the mid 60s to over 100 based on that conflict. And the worst performing asset class, US large cap stocks, that's the S&P 500, down 4.33% for the quarter, which doesn't feel great, but feels great relative to certainly those negative headlines in the US potentially going to war. What I do want to point out is the performance of a diversified portfolio. So in this case, that represents 60% globally diversified stocks, US, international, large caps, small caps, mid caps, and 40% US bonds. So if somebody hadn't opened their statement, which wouldn't be a bad thing, don't look, that's what we encourage you to do. You probably would think that your portfolio would be down significantly more. So a diversified portfolio down 1.85%. Really doesn't feel too bad at all. In fact, an all stock, 100%, all country, world, globally diversified portfolios down 2.21%. Things could certainly get worse from here, but they could also get a lot better. Corporate profits are expected to be really strong in Q1, and we'll start getting some of those reports next week. And as we learned last year, markets can turn pretty fast on a tweet. We saw a little bit of that this past Monday. The one thing I'm confident in is in Q2, there will still be things to worry about. It may be one or more of these items. It may be that these items are all resolved and we have a new set of potential concerns about the market. Regardless, there's always something to worry about. And historically, that's what has made investing profitable. Those who've done well over time have usually built durable portfolios while also possessing the secret ingredient, the temperament to ride out the all too common dips in the value of their portfolios. If you'd like to talk with any of us about your own portfolio, please reach out. Happy Easter and happy spring.